Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the presentation of part 4 of chapter 4, completing the accounting cycle. Now we are going to talk about how to prepare the post-closing trial balance. You must have noticed a pattern already by now in terms of the accounting cycle, which is a process, okay? And the process involves the step-by-step procedure for preparing financial statements, all right? So, assuming that this is a brand new company, we start with analyzing and journalizing transactions. Then the second step is we post to the ledger. And then the next step is we prepare unadjusted trial balance. So you need to catch this. This is important. And we talk about the why of each step. So the step number 1, we analyze the transaction to figure out which account goes up or go down, what needs to be debited and credited. Then we journalize, meaning we record it in the journal. Why do we record it in the journal? Because it is a good business practice to record transactions in the journal. Otherwise, we can't remember everything, all right? So then the next thing we do is we post to the ledger. We talk about the ledger is another accounting book or accounting record. And we post to the ledger in order to determine the balance of each account. Then the third thing we did was to prepare unadjusted trial balance. And we prepare unadjusted trial balance to make sure that we did not mess up during our posting process. After preparing unadjusted trial balance, then the next thing we did was to journalize adjusting entries. Again, we are now going back to journal entries. After we journalize adjusting entries, we post to the ledger. After posting to the ledger, what next did we do? We prepare adjusted trial balance. See, the first 3 steps and the next 3 steps are pretty much the same. Journalize, post, trial balance. Journalize, post, trial balance. So at that point in time, we have what? We have prepared 2 trial balances. As you can see, we prepare a trial balance right after posting. So guess what? So that's 6 steps. Then the next one was we wind up preparing what? Closing entries. We just talked about how to prepare closing entries. After preparing closing entries, anytime we prepare entries in the journal, the next logical step is we post to the ledger. So we wind up posting the closing entries into the ledger. Again, right after posting to the ledger, we prepare a trial balance. Aha, another trial balance. This is the 3rd trial balance now. So the first 3 trial balance. The next 3 trial balance. Another 3 trial balance. 3, 3, 3. So the 3rd trial balance, we call this post-closing trial balance. Why do we call it post-closing? Look at the word post means what? After. That means the trial balance that we prepare after closing entries. So the accounting cycle ends with a post-closing trial balance. So obviously there are certain accounts that you're not going to see in the post-closing trial balance. Those are the temporary accounts because they have been closed out and we prepared this trial balance right after closing. So obviously only permanent accounts are going to be there. So here you have the post-closing trial balance. Of course, the trial balance again is in balance. We prepare trial balance every time we post to the ledger in order to make sure we did not mess up during our posting process or just to check our arithmetical accuracy. Now, we are almost there, believe it or not. Now let's describe the accounting cycle. Remember what the accounting cycle is? We say it is a process for preparing financial statement. It consists of step-by-step procedure for preparing financial statement. In other words, Financial statements are not prepared haphazardly. You can't just do whatever you want to do. So you have to take a step-by-step approach. Now, let's take a look at the steps here. Remember at the beginning, this textbook have 10 steps. Remember at the beginning of the chapter, I indicated that the number of steps is not carved in stone because different textbooks or different authors arrange the steps differently. But at the end of the day, we are all doing the same thing. So look at step number 1. Step number 1 starts with the beginning account balances, assuming that the company was in existence. The company is already in existence and it's not a brand new company. So of course the company will have a beginning account balances. Those are the permanent accounts. So we start from there. Then the second step is we analyze and journalize transactions as they occur. The third one is post entries to the account. The fourth, we compute the unadjusted trial balance. The fifth, you enter the unadjusted trial balance in the worksheet and complete the worksheet. Number 6, we journalize and post adjusting entries. Number 7, we prepare the adjusted trial balance. Number 8, we prepare the financial statements. Number 9, we journalize and post the closing entries. And number 10, we prepare post-closing trial balance. Number 1, we start all over again in the next one, accounting period. So we go through this every accounting period, which will be monthly or quarterly or semi-annually, so on and so forth. Bottom line is, what is the purpose of this whole craziness? Production or creation of financial statements. Now, of course, recall when I told you about the first 3 steps, the top 3 steps, 3, 3, 3. I did that intentionally and I break it down into 3, 3, 3 so that you can notice a pattern. Intentionally, I'm missing one thing out of those 5 things. Right after you prepare adjusted trial balance, obviously you need to prepare the financial statements as they indicated here, because that is the bottom line of this whole exercise. So we are almost done. Let's take a look at the objective 6. Use the current ratio to evaluate business performance. Recall we said that overall our objective in this class is to learn accounting principles or accounting rules, how to apply them in order for us to be able to prepare financial statements in accordance with the rules. Then, in addition to preparing the financial statement, which is basically valuable information that is used by internal and external users, as accountants, we are also responsible for analyzing the financial statement. In other words, determining or figuring out what do the numbers really mean. And there are different ways of analyzing or determining what the numbers actually means. One of the techniques is called ratio. Ratio simply establishes relationship between 2 numbers. A very popular ratio that creditors use is what we call current ratios. It measures the company's ability to pay current obligations. Now, what do you use to pay current liabilities? Of course, your current asset. So the ratio establishes relationship between current liabilities, which are your current obligations, and your current assets. All right. So the formula is simply total current assets divided by total current liabilities. So the interpretation of that is simply this: if your total current asset divided by total current liability, if your total current assets is 500,000 and your current liabilities is 250,000, that you divide 500 by 250, that will give you 2. The interpretation of these is, here is the conventional way of writing this. We say 2 to 1. What does that mean? That means for every $1 that you owe in current liability, you have $2 to pay it off. So what does that mean? That means the current ratio. So the higher your current ratio, the more likely that a creditor will look favorably on extending you short-term obligations. Now, that is not only what they look at, they also compare your current ratio with the average company in your industry. We call that industry's average. So if your current ratio is 2-to-1 and the average company in the industry in which you are operating is 3-to-1, then of course your current ratio is not that impressive. Believe it or not, this is the conclusion of chapter 4 presentation.